Thanks, Dave. Dave, we'll just give a couple minutes for everyone to just join and get settled in.
Sounds
I think
good.
it's gonna be an interesting one.
For sure. For sure.
Let's see. Oh, I don't I don't think we're short of anything interesting to talk about these days, Dave.
Right? Even just in the last 24 hours, right? I mean, but that's the nature of the markets in 2025, you know?
Well, I mean, I started the year, I was actually hoping for a little bit calmer markets and just kind of normalcy. I don't know. Is that just too much to ask for these days?
I think so. I think that is literally too much to ask for, Michael. I don't know. And I know, I mean, definitely the sense here after the elections last November, you certainly had the sense that 2025 was going to be an eventful year in good or bad or in between ways. It was going to be eventful, and it has been up to that for sure. It has
Yes.
followed through on that expectation, I would say.
I think April will definitely be the one to be remembered.
For sure. And I think if anything else, it forces you to think kind of second level about everything, you know, because there's so many ripple effects to so many things that are happening and the interplay of all the different charts that we'll look at and things that I
Yeah.
look at day to day. I mean, it really I think it forces you to think as a trader, as an investor, and I don't think that's a bad thing. We'll count that as a positive.
Well, I think so.
Easy
And
markets are boring, right?
well, I've spoken to a lot of other, CIOs and head of investments, and they're like, when things are uneventful, there's not a lot of opportunity. So it really depends on how you're positioning yourself.
Yeah.
Obviously, right now there's a lot of volatility. There's a lot of opportunity. If you're positioned well, then it's great. If you get caught offside, then it's not happy days.
For sure, for sure. And most people experience a little of both, if not a lot of both in a year like this, and that's okay.
Yeah, I think so. I think, let me just double check. I think we've got quite a few attendees joined now. Yeah, we've got quite a few. I think we're pretty pretty well ready to get kicked off.
Okay.
Thank you everyone for joining us this evening. I promise you it's going to be interesting. We're going to be talking about technical analysis with Dave Keller. Our title is Charts First and Emotions Last. So really trying to just dig in, looking at the numbers, the charts, and making informed trading decisions and taking that emotion out of play. Before I hand it over to Dave, as usual, we will have to talk about our disclaimers. For sure, even Dave can't tell the future. We can't tell the future. We don't have a crystal ball. So, what happens in the next few months or years, no one will be able to tell you that. So we're just trying to give you some tools and informed decisions. And our views are not as one-on-one advice. So do your due diligence before making any decision that may impact your financial well-being. All investing is subject to risk. All right. Thank you so much. And Dave, I'll hand it over to you and let you tell us about yourself and tell us what we're in for tonight.
No, happy to do it, Michael. Thanks so much. I appreciate the introduction, and thanks, Shad, at the team at and the team at Sarwa for the invitation and for making this a really enjoyable presentation so far, just to get ready for it. When we talked about a discussion to share with all of you this evening, we immediately started talking about routines, and one of the things Michael and I were talking about was just the importance of how you spend your time, right? There are things that you can control in terms of how you spend your time, what you read, what you watch, what you listen to. There are things that are out of your control, like what's going to happen in the markets in the next minute or the next day or the next month. And I have found that traders tend to get into trouble when we spend too much of our time focusing on things that we really have no ability to adjust. And we underappreciate the meaningful changes we can make by improving our processes, our routines. In my career, and I'll talk a little bit about my experiences in the financial industry, working at some large financial institutions, working with a lot of successful traders. And I will tell you, the most successful traders aren't right all the time. They're just pretty good at knowing when they're right and pretty good at admitting when they're wrong. And I would say a consistent process, a consistent routine of analyzing the markets and structuring your trades effectively is what's going to help you have better experiences as a as an investor, as a trader over time. So what I would like to do is just talk a little bit about an investment philosophy that is built around good routines and consistency. And I have found that inconsistency is one of the worst things. It's a four-letter word for traders, inconsistency, because it just causes you trouble. Here's my own experience overlaid on the chart of the S&P 500. And you can see with some of the icons if they're familiar, and if not, I'll talk through some of them. But my experience has taken me starting in June of 2000 at Bloomberg in New York City, where I learned all about technical analysis. I learned that there's a set of tools that helped you address your own behavioral challenges. It's a toolkit designed to help you recognize mistakes and learn from them and minimize them the next time. And I was completely hooked at the psychological aspects of technical analysis. And by the way, I studied music and psychology as an undergraduate. That's off the left side of this chart before I really knew what was going on in the financial industry. But I will tell you that that technical analysis is somehow combining music, analyzing patterns and trends in data, and also psychology, understanding how people are thinking and feeling and what they're doing based on their emotional state. I was a managing director of research at Fidelity Investments from 2008 to 2016, where I had the opportunity to work with a lot of successful investors. Got involved with the CMT Association. I was the president of that organization from 2010 to 2014. And my first experience in Dubai, where I actually met Michael, was at a CMT Association event. And Michael, I hope to see you at the one later this year for sure. My experience then continuing on to stock charts and now as a CNBC contributor and my own firm called Sierra Alpha Research. My goal of showing this slide is just to show you that the longer that you're involved in the financial markets, whether you're trading, whether you're a position trader, whether you're a swing trader, anything in between, whether you're a professional or just an individual managing your own account, the scars that you get over time are what make you a more successful trader, right? The painful lessons you learn from these significant drawdowns. As an example of that, I learned technical analysis mainly from 2000 to 2002 was sort of my steep learning curve years. This was through a very challenging period in the U.S., certainly in the world, with the tech bubble bursting, with a lot of things happening during that period. And so for me, I learned a lot about risk management. And when I was introduced to technical analysis, it was about helping you recognize when trends were no longer in your favor. And I think that very simple assessment of analyzing the chart and determining, is this the right time to make this trade or not? And just doing that consistently, I think that's the game. And I hope through what we talk about today, I give you some examples of where technical analysis can provide some good risk management tools for all of you. Just so you know where I'm coming from, I'm actually based in Redmond, Washington, which I always tell people is the upper left corner of the United States, if you're not familiar with this area. And not too far from here, our own Michael Chu is from Victoria, BC, which is not too far from where I'm at. So a fellow, I guess, Pacific Northwesterner here.
Yep. Been
This
through
area.
Redmond.
Yeah, that's
We're
right. That's right.
neighbors.
You've been there, right? So, with this area of the country, it is a beautiful area. This time of year, it's pretty comfortable. The summers don't get too hot, the winters don't get too cold. We're surrounded by mountains and water. It is a really beautiful area of the United States. And if you have an opportunity to come to this area, I hope you do at some point. But the reason why I wanted to show you where I'm from is to show you this. This is a picture of my son Henry and I at a Seattle Sounders match. So the local football team, soccer team here is the Seattle Sounders, part of Major League Soccer, definitely a mid-tier global soccer league, I would say at best, but a lot of fun. And they play in the American football stadiums that we have here. A lot of the clubs. So it's a great vibe, a great environment, passionate fan base for sure. This is a picture just as we learned we made it through to the next round of the MLS playoffs last year. And the reason why I'm showing this, my son plays club soccer. So we're traveling around between Washington State and Oregon and soon probably other states as well. And he's playing clubs with other, kids learning the game in different places. And he was struggling in his first year playing club soccer, which is a more competitive level. And, he was talking about, well, what if this happens? Well, what if the referee does this? What if the goalie something? And he started listing, he was just really nervous and he was kind of, turning white and, just kind of getting really unsettled. And I told him, I was like, Henry, listen, you're spending all your time worrying about things that you have no ability to change, right? You're worrying about what other people are going to do. You can't change what the other team's going to do. You can't change what the referee's going to do. You can't change how the ball is going to move, but you have full control over certain things, how you prepare, how much sleep you get, what you eat, what rest do you get, right? How you heal yourself if you have injuries, your mental state, and making sure that you're approaching things in the right way, arguably the most important thing. So what he and I realized was the quote that we often throw around before a big soccer match coming up is don't spend your time worrying about things that are out of your control. Does that sound familiar to any of you with how you may be approaching the markets on a given trading day, right? We worry way too much about things we have no control on. What's going to happen to interest rates? What a presidential administration, what headline may come out the next moment, geopolitical issues, right? None of these things we can directly change, but we can change what we read, what we watch, what we listen to, how we analyze the markets, how we structure our trade, how we manage risk. And so I find way too often we love to talk about things we can't control. We don't like to talk about things that are in our control because usually those can be painful because those are things that we have to fix, right? Now, I will tell you that having spent 25 or so years now analyzing investors and traders and analyzing price action as a way of understanding their behavior, I'm fully convinced that the markets are driven by emotions in very small ways and very large ways. I think fear dominates our thinking in most aspects of what we do with our portfolios. When the market's going up, it's FOMO, right? Fear of missing out. We fear that we're going to miss the next big move. We're afraid that we're not going to be participating in the next NVIDIA or AI trade or whatever the next stock is going to be that pushes higher. On the downside, it's the fear of losing everything, right? It's the fear of our portfolio going to zero. It's a fear that we're going to get stopped out. And so it's a problem, I would say, if your entire approach to the trading day is driven by fear, right? Is driven by what you're afraid of the most at any given point. Now, the good news is traders are not the only people on this planet that have to deal with something that tends to generate emotions. And one of the things that I will share with you is another a discipline where people deal with emotional issues as well. Now, how we get through emotional challenges is we need to focus on the evidence. Now, what we normally do as emotion-driven investors, as emotion-driven traders, is we actually make our decision first, and then we start gathering evidence. This has probably happened to you, right? You think, I'm bullish on this stock, I'm bullish on Bitcoin, I'm bearish on crude oil, or whatever it is. You make the decision first, and then you start reading about it, and then you start listening to interviews. And all you're basically doing is reinforcing something you were already going to do. That's called confirmation bias. Because what you're basically doing is just gathering evidence for the pure benefit of making your fragile ego, nurturing your ego and making it feel a little bit better about a decision you're already going to make. What we want to do is completely flip that script. And what I'm going to do in the presentation today is we'll show you some of the routines that I go through every morning to just make sure that I'm focused on the evidence and not on some decision I'm already going to make, right? We want to gather evidence first. We want to look at the weight of the evidence. We want to see what the charts are telling us about market conditions. And then based on that gathering of evidence, we then want to make a well-informed decision. So what we want to do, and I hope you can think about ways you can improve this in your own day-to-day routines, get away from an emotion-based process to an evidence-based process. So, what is this other mystical group of people that have to deal with emotions? It's pilots, right? People flying around all day. And I will tell you from my own experience, I'm a student pilot with about 85 hours, mostly in a Cessna 172R in different parts around the United States where I've done different flights. And I will tell you, one of the first things you learn is basically to get out of the way of your emotions, to stop using emotions as part of your decision-making process. Everything you do in the plane has a plan, it has a checklist, it has structure. Because what pilots found a long time ago is if you make decisions based on your emotional reaction to what's happening in the airplane, you usually make a very poor decision. And the bad news is when you make a poor decision in an airplane and things go poorly, it can end very bad. And so that's what we want to avoid. So most of your training focuses on emergency decision making and how to get through crises and how to do so in a way that doesn't, completely jar your emotional state. There's a famous quote that pilots pass around. There are old pilots and there are bold pilots. However, there are no old, bold pilots. And what that means is there are pilots that have been around for quite some time. There are pilots that that are aggressive and make aggressive emotion-based decisions, but those groups do not overlap because the pilots that make aggressive, uninformed, emotional decisions don't last very long in the cockpit. So what we want to do is have a sustainable career as a trader and live to invest in another day. So, what do you learn if you've ever tried to fly an airplane? What you learn is that decision making is based on the evidence that you gather. And in the bottom right, you can see on my slides, I'm mentioning that I have the CMT designation, which stands for Chartered Market Technician. A big part of what improved my thinking about investing and certainly more structured ways of analyzing charts and trends came from going through the CMT process, series of exams that teach you how to approach the markets in a systematic objective way as opposed to a subjective emotional process. So, applying that sort of thinking to aviation, what you find is that literally everything has a checklist. In the upper left, this is the checklist just before you light up the propeller on your airplane. You turn on the master switch, the emergency beacon, you get the fuel going, you yell out the window, and then you light up the propeller. If your engine cuts out in midair, which hopefully never happens and has never actually happened to me, although I've done a bunch of simulated engine cutouts, they're not enjoyable, I will tell you. But what you learn is that you don't have an emotional reaction, right? The first time you do a simulated engine cutout, I'll tell you what happens is you absolutely panic. And my palms are sweating a little bit just recapping this experience, but the whole plane kind of shudders and the nose tips down and it just feels like the plane doesn't want to fly anymore. And as that's happening, you're supposed to find this little piece of paper and go through this checklist, checking your airspeed and checking the fuel. And it's a very difficult decision and a challenge. And so your instructor usually has to take control and you talk about, all right, what happened? How do we do it? And I will tell you, after months of doing that, an engine cutout is no big deal. It's just another thing that happens, right? You hear the sound, you feel the sensation, you go, yep, da-da-da-da. You don't even need the paper, you just know what to check, and usually that corrects your issue. So what they have learned is by having checklists, by having systematic ways of approaching everything that they do, the chances of human error go down dramatically. The chances of some random thing that's unexpected happening goes down dramatically, and we're able to plan more consistently. So my question I would pose to all of you, why would you do anything different with your trade, right? With your portfolio? You should have that same sort of approach of thinking in a structured, disciplined way. So this is literally the 7-step process that I use to evaluate any trade that I'm going to make from a short-term swing trade to a long-term allocation decision. I go through this, checklist of 7 things, and I'll recap very quickly what it is. It starts with trend. Is this chart going up or going down? Are we in an uptrend or a downtrend? And how can I validate that by analyzing the chart? And we'll show some examples of this in a short while. Moving averages. Let me smooth out the price data a little bit, get away from the noise of the day-to-day action, and just evaluate the trends. Overall, are we in a constructive or negative environment based on the changes in the moving average, what we call the shape of the moving averages? Are there any price patterns, right? Candle patterns, head and shoulders tops, things that would tell me that there's a shift between supply and demand, between buyers and sellers that the chart is trying to tell me. Are we near any key support or resistance levels, right? Are there levels, price levels at which this stock or this ETF has turned before that I might anticipate buyers or sellers are going to take action? Can we confirm that anything of the above using indicators like RSI or MACD or any of these other indicators? Relative strength tells me how a stock is doing relative to other stocks or benchmarks. And then probably the most important one is an exit strategy. And I would encourage you, hopefully there are a couple things that you take away from our discussion today. I would say, and this sounds a little pessimistic and unintentionally so, go into any trade assuming you're wrong. And I'll show you what I mean about that. It's not a bad thing. It's actually a good thing because it forces you to get away from overconfidence and be a little more realistic about what your risk versus reward is. We'll talk about exit strategy because I find that that's one thing people undervalue in their trading process. So to summarize, right, what you need to think about is being more mindful about your trading, more mindful about your portfolio. And what mindfulness means to me in this context is having a good situational awareness, having awareness of what's happening around you, how the flickering ticks are moving, flickering ticks of the markets. Mindless investors, if we do this the wrong way, we tend to be overconfident. You approach a trade assuming you're going to be right. You buy Meta in early February, and you can't imagine a scenario where Meta stops going up. And this is a trap that many investors fell into in the first quarter of 2025, right? The AI trade is lighting up. Uh, Technology conglomerates like Meta and Alphabet and Amazon and others are just ripping to the upside. Stocks like Palantir are going vertical, and there's this sense that that's just going to keep going forever. And there's a lot of talk along those lines at that point. But if you've looked at enough charts, you realize that when things start to accelerate, there is a moment where buyers start to, want to take profits. And there's a moment when things feel very overextended. And then there's a moment when things start to turn. And the chart of Meta, like every others, showed that reversal with a major sort of reversal candle at the very top, and then continued weakness soon afterward. In the weeks after that peak in mid-February, there were plenty of signals I would tell you on the chart that told you things are starting to get worse. A mindless investor ignores the fact that the evidence is changing and does not have a good exit strategy. So then we're making an emotional decision here as to whether or not we still want to feel the pain of the paper loss in Meta, as opposed to a very systematic decision of Meta broke my stop, I'm out, and I'm going to move on to something else. So how do we fight that? As I mentioned earlier, you want to approach a trade with humility. You want to approach a trade, at least for a brief moment, step back your confidence and just think about, what if I'm wrong? So this is not my actual trading journal, but this is a fake page, a dramatized page of my actual journal that I use. And this is literally the process that I do when I'm making any trade to this day. There are a lot of great technological ways of managing your trades and tracking them. I do it very old school with pencil and paper in a notebook because that's what works for me. So every time I make a trade, there are three lines that I write down in my journal. Line number one, what did I do? I took this position of this stock at this level or this ETF at this particular level. Very factual. Line two, why did I do it? And this is actually a pretty small kind of half-sized journal on purpose because I don't want to get too verbose about some dramatically long and involved investment thesis. It's just very simply like, what was the edge? What was the thing that I think is really going to drive this trade in the way that I think it's going to be? So on this example, which is just a fake example here, I said short-term pullback within a long-term uptrend. Fat pitch, which is a baseball term. If you know baseball, a fat pitch is basically a pitch right over the plate that if you're a batter, you have to take a swing. It's just such a great setup. You really want to take it. So this looked like a classic buy opportunity within a stock in an uptrend that had pulled back, one of my favorite patterns. So that's what I just want to remember. This is why I bought Krispy Kreme donuts, whatever ticker that I just wrote down there. All right, finally, what's my exit strategy? And so the third line is basically where I assume for a brief moment I'm going to be wrong. I'm assuming that this trade is not going to work. And what is the chart going to tell me to show me that I need to change my position. So in this case, I said the stop is set at $50 even. I'm entered it at 51.50, which gives me, a little bit of room on the downside, not much. It's a fairly tight stop because we've already pulled back a little bit. So the idea is I'm buying a pullback, I'm expecting it to rotate higher. If it doesn't rotate higher and keeps going lower, I want to get out very, very quickly because that means my whole thesis was wrong. So again, I'm defining why I'm going to be right, but I'm also clearly defining why I might be wrong. And I find that third line is something we don't want to think about because that's basically assuming our brilliant trade is not going to work. But you need to do that. And I think that's the humility that comes with investing. If you don't do that, you'll have enough losses that you will be forced to start to do that at some point. But I think money management is so important. So assume you're wrong and think about an exit strategy every time you put a trade on. That's my suggestion. All right, a couple more thoughts, and then we'll look at some charts. Michael, sorry, did you have something to say? Okay, good. Okay, sorry. All right. So let's talk about a couple more things here. When we look at charts, we're going to talk about some different time frames. All right, and I just want you to understand why that matters. Having worked with a lot of traders, and I've had the opportunity to work with some successful money managers at Fidelity, Peter Lynch, and other types of investors, but also Steve Cohen and other successful traders, and try to learn as much as I can from their experiences and how they approach what they're doing. And I will tell you that one consistent thing that I've found, one consistent quality, is a respect for multiple time frames. Unsuccessful traders kind of put the blinders on and they focus on one trade, on one moment, on one time frame, and that's it. But what happens then is you miss the fact that there are other investors on other time frames that might be moving a lot of capital in and out of that particular stock or ETF at any given point. So what we want to do is think about where our time frame fits into others. So the way that I approach my process is I think about the time frames that are most important to me, and then I've structured an investment routine that helps me respect those three different time frames. So for me, my main time frame, I'm probably more of a position trader, and I, average trade maybe 1 or 2 months on average, although I'll hold longer positions if they work, and I'll definitely take shorter bets as well. But my average position is probably a month or two. So I call that the cyclical time frame, right? If I want to sort of identify what's happening 2, 3 months down the road, I think of that as kind of the cyclical pattern, the normal cycle that happens in the markets. And that's sort of this orange, crudely drawn line that you see on your chart. That's my normal time frame for an investment. So I have a weekly routine that I do every weekend where I really focus on that time frame, where I think, all right, what just happened this last week? What levels, patterns, signals occurred? What did I learn? And then I look forward at the week to come. What levels, patterns, signals am I watching for? And I write those all down just so I understand. And it's when the markets are closed. I do it on a Sunday morning, early before my family's up, quiet time with a cup of coffee, and just sort of look at what has the market told me in the last week. But then every morning, and this is where we're going to focus here in a moment, is what I call my daily routine, where I think more about the tactical time frame. What's happening one day to the next? How is the market evolving relative to the expectation that I set based on my analysis over the weekend, right? What was new? Here in the US, we had inflation data yesterday with the CPI, today with the PPI. What am I learning, right? How are investors reacting to earnings or news events? And what can that tell me about prospects going forward? I call that the morning coffee routine. First thing in the morning, grab the cup of coffee, look at the charts. Then finally, I have the longer term time frame. I have to remember that there's also a secular trend, right? Where secular themes come in or out of favor, where crude oil prices go down for months, if not years, and then start to meaningfully change and arguably starting to break out this in the last couple of weeks. The monthly routine for me is an opportunity to take a big step back from my monitors, think more of a larger 30,000-foot view, and think about how things are evolving 1 month to the next. And when I think about the last couple years and recognizing, strong bull markets like 2024, major tops like we experienced in 2021 into 2022, that monthly routine more than anything has really helped me recognize when things are different, when leadership changes, right? Growth to value, offense to defense. Those are things that it's hard to pick up day to day because there's so many things you're looking at. But having a time where you have an intentional analysis of what's evolving is super important. So that all was an appetizer for what I hope is the main course, which is looking at some charts together. And what I'm going to do is just start with my own morning coffee routine. I actually did this. It's 7:30 a.m. local time here in Seattle, and so a couple hours ago I got up and went through some of these charts. I just want to share with you how I go through them, and in the process, hopefully you'll get some sense of how we look at trends, how we think about potential reversals, how we identify actionable moves versus just sort of normal market noise. And I hope it elicits some great questions from all of you. All right, so let me get that out of the way. We're going to look at some live charts. So
Yeah. Just to remember for everyone that's tuned in, the question chat is open. So if you do have a question as Dave's going through some of the charts, just please put your questions in and we'll definitely try to get to them near the end of the presentation.
yeah, thanks, Michael, so much. All right, so this is what I call my morning coffee routine. I start with this same set of charts every morning. I went through them a couple hours ago. I'll go through them again tomorrow. And I will tell you, life changer for me as an investor. This was probably 15 odd years ago. Before I started doing a consistent morning routine, I would say my process was unstructured and fairly ineffective. I would randomly have great trades, and I feel like that was more a coincidence than anything. And since then, since I've had more discipline and more structure, I found that results are more consistent, right? Consistent routines lead to consistent results. I truly believe that. So let's go through some of the routines that I do. I actually start every morning with a weekly chart of the S&P 500 index, and that's the chart that we're seeing here. It's going back for the last 5 years, which if you're more of a swing trader or a day trader, this feels like an outrageously long time frame. But bear with me because for me, this hits on the time frames that are most interesting to my process. You, of course, should adapt this sort of routine for what's going to help you answer the questions you're trying to answer in your portfolio, in your trading. So for me, I look at the weekly chart of the S&P 500. I have a series of what are called exponential moving averages. So it's the 5, 13, 21, and 34 week exponential moving averages. If you know technical analysis, those are Fibonacci numbers, if you're wondering where those numbers actually come from. But as I was designing what I call my market trend model years ago, I was looking at the weekly chart of the S&P every day and just sort of analyzing what are the trends, what are the movements, what's the long-term trend, what's the short-term trend, and just helping me understand before I start trading today, just let me clearly define the trends in the market so I generally am on the right side of things. So the long-term trend for me is defined as the difference between the 21 and 34 week exponential moving average. So two very long-term moving averages, the red and the purple lines that you see there. And when the 21 week is above the 34 week, the histogram is above zero. And that's a kind of a buy signal, right? When it goes from below zero to above zero. So the last bullish signal we had was at the end of March of 2023. And from that moment on, even with the volatility we had in 2025, by my analysis, the long-term trend, right, the secular trend in the markets is still quite strong. The medium term trend for me is the most important because this is how I manage a good amount of my portfolio, is just thinking about whether I want to be adding risk or subtracting risk, whether I want to be taking more aggressive bets or pulling some of those bets off, or how I think of it. Do I want to focus more on capital growth or more on capital preservation, right? Do I want to be growing the portfolio or just protecting it from shrinking? And I think that mindset can be very powerful. So the medium term model for me is the difference between the 5 and the 13 week exponential moving average, these other two moving averages on here. The medium term model for me turned bearish at the end of February, basically telling me that was a major top. I probably want to get big time defensive, which I did. And then for me, didn't turn back bullish until the beginning of May, which was a pretty significant rally. The problem with what we experienced, and I'm sure many of you did as well, when you have a V-shaped sell-off and then a V-shaped recovery, it's often very easy to get out in time, which I felt like I did. I felt very good right around here because I was out. I was in defensive positions, owning like gold, which was doing fine. And I'm thinking I'm a rock star this year. 2025 is the year of Dave Keller. But then talk about the humility that happened in the weeks after as the market just hits this sudden V bottom. And I've seen that before, right? The financial crisis in 2008, 2009 had an almost identical look and feel. Different macro environment to be sure, but very much that V bottom. And if you go back in time, if you were trading then, you probably know this. And if not, read about that period, right? Banks got absolutely clobbered on the way down. But then charts like Bank of America, Citigroup just ripped to the upside right after the, I mean, just this classic V bottom. So the things that led on the way down absolutely led on the way back up. So for me, that's an acceptable part of navigating this period. Wait for the confirmation. And for me, by now, I think you have to recognize that the trends are clearly positive. So my medium-term model and the long-term model bullish. The short-term model for me turned bearish actually early February, telling me that things were getting overextended. And the short-term model turned bullish in mid-April, 2 weeks after the low. So by looking at this every morning, I am just recognizing what are the trends. Before I look at Nvidia or Apple or Starbucks or whatever stock I'm going to bring up, what is the trend in the market? So I would encourage you to start with that general assessment, right? What's the bias with which the market is opening? The second chart that I look at every day is this one, a daily chart of the S&P 500. And this is to dig in a little deeper to the day-to-day movements, focusing on key levels and patterns and signals. I would say undeniably the S&P has been in a strong uptrend phase, but I would say in the last month, things have shifted quite a bit, right? The market's actually gone through, I would say, 5 or 6 kind of mini phases in 2025 from the initial rally that felt like 2024 was going to keep going for the next year to all of a sudden the initial sell-off, which all of a sudden felt very different and leadership chart started to change. The tariff announcements, which actually happened in early April, which really accelerated the downtrend phase, the recovery, et cetera, et cetera. But I think this period, which we'll focus on, I think next is pretty important because for me, it's certainly defining how I think about the U.S. equity markets. The S&P 500 gapped above price resistance. This was the swing high that we had after the first leg down into early March. We had this upswing here. If you know your candle patterns, this is actually one you may not know, but it's called an evening star pattern, which is a really cool one, where you have an up day and you have a big down day, but you have this little sort of indecision day right in the middle. So a big up move, a pause, and a big down move. And it happened right at the 200-day moving average. So even though I'm more of a position trader, I absolutely pay attention to short-term swings and signals because that helps me understand how at least a big group of market participants are going to be probably playing that period. And when that bearish candle pattern happens right at the 200-day moving average, that tells me, okay, I probably don't want to be adding to something right now. I probably want to wait and see if there's a further drawdown, which undoubtedly there was, right, for sure. But this gap higher that we saw last month in May took us back above that resistance, took us above the 200-day moving average. Paul Tudor Jones famously said, nothing good happens below the 200-day moving average. So that is a basic litmus test a lot of investors use to determine whether or not this market is in decent shape or not. From that gap higher, we traded up and then pulled back to the 200-day moving average again, where we found support. And I think that's crucial to my analysis right now. When we break out and then test the breakout level successfully, that further validates the fact that this uptrend is in pretty good shape. Now, what was different in this period right here is the leadership all started to rotate around a little bit. If you look at the chart of Meta or Alphabet or Apple, Nvidia, on semiconductor, any of the sort of semiconductor names, they all kind of chopped around during this period. And the sectors that were actually doing well in this 2 week period or a 3 week period were more defensive sectors. Things like utilities and real estate and consumer staples kind of stocks were doing quite well. That all has changed now in the month of June. So as June started, growth stocks are doing better again, right? Stocks like Meta are breaking out. Semiconductor stocks are arguably some of the best moves that we've seen. Sectors like industrials, aerospace, defense names starting to pull back a little bit. And so I think we're seeing yet another rotation here back to kind of traditional growthy offense. Sectors like technology, communications names, internet names, AI names. And I think as long as that persists, I think the trend is in good shape. So the way that I think of this market, and I will tell you, I call it the stoplight technique, right? I'm a big fan of simplifying. I find way too often in the financial industry, we love to overcomplicate. And I would say as a trader, simplifying is a good thing, right? Well researched is also good, but let's simplify our approach. I think of this market right now in terms of my own portfolio as a stoplight. So we have green meaning good. The S&P remains above the swing low from mid-May. That was that pullback that we talked about to the 200-day moving average. I think as long as the S&P remains above 5750 or 5800, I think you could attribute anything above here kind of as noise. And pullbacks probably, I would say generally, I would probably be looking to buy pullbacks and bet on that trend to continue. If, however, we would break below that level of support, I think we're in a yellow light. That's where I would probably start to take bets off in my portfolio, at least get a little more to neutral positioning, because that tells me that support is no longer holding, and at least some sellers are really starting to push assets lower. And you can see the red light for me is the S&P below 5,500. If we get down to that point, that would tell you we're having another sort of real distribution phase. Support is not holding. Leadership has probably changed pretty dramatically in that scenario. Defensive sectors are probably looking very, very good. And I think there'll be a lot of warning signs before we go from 6,000 to 5,500. But I will tell you, if and when we would get to that point, that's where I'd probably be fully defensive into cash-like items, high yielding, higher dividend paying names, gold, hard assets, things that are most likely going to, sort of navigate through that period. So again, this is me as a, more of a position trader thinking about how I might allocate given these different scenarios. I would encourage you to think about it with your own trading. This is a sort of simplification, a sort of mentality you could apply to a short-term trade. You could apply to a daily chart of a stock or ETF and just think about, all right, if it's above this level, I'm in good shape. If it's in this range, I probably want to start buying on the dips. If it gets below that point, I'm probably stopped out, right? Thinking about what the chart would tell you to indicate that you're no longer in a good place. Just given time, Michael, I want to make sure we have time for questions, but I just want to hit on a couple more charts if is that okay?
That's perfect. Thanks,
Okay.
Dave.
All right. So I'm trying to cover some different asset classes, different charts that I think might be of interest to you. And again, any questions are welcome if there are particular charts or anything that you're looking at and struggling with for sure. From a macro perspective, I mean, these are unprecedented times in so many ways. And I would say I've had plenty of questions about does technical analysis even work at a time when it's all about headlines and all about policy decisions and geopolitical events? And my answer would be it probably matters more now more than ever. And I will tell you why. Because if investors are getting nervous, the charts are going to reflect that. If investors are optimistic, despite bad headlines, the charts are going to reflect that. If non-US investors are rotating back to the US markets, I think the chart of the dollar would reflect that. If people are nervous about inflation or anything like that, I think the chart of interest rates will probably reflect that. So you have to remember that charts, are valuable in terms of understanding how other investors are maybe positioned, and certainly what sort of optimism or pessimism is being reflected. And I think price action is probably the best answer there. So I will tell you one thing that concerns me about the current market in the U.S. is the fact that the dollar remains so remarkably weak. I think a lot of investors in the U.S. have undervalued the benefit of non-U.S. investors converting to U.S. dollars and buying U.S. assets. I would argue that a lot of the bullish experience we've had in the U.S. equity markets in 2024 and other years have been driven by liquidity, driven by money coming into the system. The weakness in the dollar suggests that that's really not happening, and the dollar today appears to be making a new 52-week low. So until and unless we see the dollar start to rotate higher, I'm skeptical that the U.S. equity markets are going to have sustained gains beyond what we've seen so far. I think the dollar probably has to start improving better than we've seen for me to really be optimistic about that. One good thing about the dollar becoming so weak, though, certainly non-US markets are looking dramatically positive. So when I look at charts of developed Europe, developed Asia like Japan, arguably much better than the US markets for much of 2025 as a result. But also crude oil prices, which of course are denominated in US dollars, are looking more and more constructive. The energy sector is one area of the market that I've been avoiding pretty consistently because crude oil prices have been so low. There have been areas of the energy sector that have done very well, and it's more energy infrastructure like pipeline companies, natural gas companies have looked pretty good, but kind of the traditional oil producers have been struggling quite a bit. If you look at the chart of the energy sector, you'll see it's starting to break out. If you look at the chart of crude oil, you can see it's breaking above $65 a barrel, which I would argue is is confirming an uptrend phase. So what's great about charts in this particular environment, there are themes that will be in play for a while. I think energy in 2025 has not been a great bet because of weakness in crude oil prices. That's starting to change, and having a consistent process of recognizing crude oil's lower, crude oil's lower. Okay, crude oil's not going down anymore. And doing that, my daily routine is where I followed this every day and said, okay, it's now stabilizing. Okay, now it's starting to go higher. Okay, now we need to think about energy stocks because higher crude oil prices are gonna help those as well. And I will say, looking at the charts has had me in gold for a long time, and more so. So I own ETFs like the GLD and IAU, which are ETFs that own physical gold, as opposed to owning gold futures or something like that. But I do have a pretty decent position in gold because the charts have justified it, right? And I will tell you, with the chart of something like gold or crude oil, the market doesn't care what you think. So if you argue gold should not be so strong because the equity markets are so strong, if the chart of gold is going up, that tells you that the chart of gold is in good shape. Final chart I'll show you, and then we can take some questions. Will be about market breadth, right? Breadth conditions are one of the sort of next levels down, right? And I find a lot of times unsuccessful traders tend to keep things way too at a surface level, right? We think things of very simplistically, and we miss the benefits of looking a level down. I will tell you, particularly if you trade, broad market futures or contracts of some sort. I will tell you, there's a lot to be gained by looking at the next level down, looking at leadership. Don't just look at the S&P 500 or some broad index. Think about the fact that that's 500 odd companies that may be doing some very different things. And breadth analysis can be super helpful in helping us identify what are the general stocks that make up those indexes, what are those doing. This is a chart that I look at every day, which combines some different breadth indicators and also leadership trends. And I'll quickly just go through what this is telling us. Here's the S&P 500 in the top panel. This is a 2-year chart, but you can see here the last 6 to 8 weeks trending higher. This is the advanced decline line for the New York Stock Exchange. So every day, how many stocks close up, how many stocks close down? That's your daily advanced decline reading. This is called the cumulative advanced decline line because you just keep a running total of those daily readings. And the idea is, over time, if more stocks are closing higher, market's probably in good shape. If more stocks are closing lower, we're probably not. This advanced decline line is pretty close to making a new 3-month high, actually very close to making a new all-time high. That's not bearish. That's actually pretty bullish if that would actually follow through. This shows you the percent of S&P 500 members that are above their 50-day moving average. It's up to around 77%, which is a pretty bullish reading, right? When we get up to those levels, that means almost everything is above their 50-day moving average. At some point, we start to pull back from those levels, but for now, we're in pretty good shape. This one is called a little more complicated. It's called the bullish percent index. It uses a technique called point and figure charts, but basically it's a different charting methodology and tells you what percent of these members are in a primary uptrend. It's currently at 71%, which is a strong bullish reading. Finally, we're looking at offense versus defense, consumer discretionary versus consumer staples. This is a classic comparison of things you want versus things you need. Let me tell you why this tends to work. Things you want, discretionary items, travel, tourism, hotels, a new car, luxury goods, a new watch, new clothes. These are things you don't necessarily need, but they're fun to spend money on if you have the ability to do so. Those tend to be more economically sensitive, right? When things are good, you usually have more money to spend on those things. When things are tough, you probably don't. Consumer staples are not economically sensitive, right? Things like household goods, cleaning products, food, beverages, tobacco. These are things that usually people will spend money on regardless of what the economy is doing. It's pretty stable. So when this ratio is going up, it's more offense oriented, right? Consumers are optimistic, investors are optimistic. When this line is trending downwards, it's the opposite. So you can see that the ratio peaked in early February. It trended down through mid-April as the market was in a downtrend phase. But from there, it's actually been generally trending higher. And I think the bullish case from here is this ratio continues to push to the upside. There are some key stocks in this numerator in the top half: Amazon and Tesla, both of which have been struggling a bit here in the last week or two. So those would probably need to resume their uptrend. But these are equal weighted indexes tracking those trends. And I think continued outperformance by offense should mean should be continued to be optimistic. So that is just a snapshot of how I think about the markets. Those were about 5 or 6 of the daily charts out of about 100 that I review every day. But I hope that this gives you a sense of how we can systematically. The idea here is not that I just analyze them right now. It's that I do the same process every day. And by doing it consistently, we can better recognize changes and hopefully manage our emotions, focus more on the evidence.
Thanks, Dave. I think you really highlighted the point that you have to put in the work. You
Yeah.
do the work. It's not, I'm just going to wake up and buy NVIDIA today because it feels good, and then try to rationalize it based on what you read. It's you have your thesis and you're doing the homework, and then you come up with your decision.
Yeah, you should have a very clear answer. It's always the tell your mother test, right? Can you call your mother and explain to her why you own this particular stock? And if you can't summarize it based on all of that work that you've done, then you need to do more work about it. And again, unsuccessful traders I found don't do that work ahead of time, and then
Mm,
you end up having to do a lot more work afterwards trying to clean up from that mess for sure.
yeah. And I, you could probably comment on this, but in the last couple of years, it was quite easy to get lucky. So,
Uh yes. Yes. And one of my favorite quotes, don't confuse brains with a bull market, right? So when everything's going up, it's very easy to get away with a lot of things. And I would say when the S&P 500 or whatever index you're tracking, when it's just kind of going up consistently, you can get away with a lot of bad habits. You can get away with not having good money management processes. You can get away with not managing risk very well because those levels are not tested. But then a big drawdown is where it's a huge wake up call for a lot of investors and probably many investors who were probably overexposed to a lot of really good growth stocks in early 2025 probably have learned a humbling lesson about being on the wrong side of that.
mm,
So yeah, I honestly, I mean, the good thing about bear markets, which I think we certainly at least gone through here in 2025, you learn a ton. And I would encourage people to treat this as a great learning opportunity. Look back at this period and see what you could have done
mm.
better. That's going to help you prepare for the next bear market.
All right. Thanks, Dave. We have a few questions.
Yeah.
Zakir asked, can you talk about the 8 and 21 exponential moving average concept to get a general guidance on market trends?
Ooh, that's an interesting
It's
one. Yeah. Yeah. So I think what you were saying is bring up a stock. I'm going to bring up a random name and then do couple. I think you said the 8 and 21. Interesting. So honestly, the market trend model that I showed is using weekly data. We can do the same
mm,
thing using daily data, right? And the idea with things like moving averages, it's scaled to whatever time frame that you're looking at. The moving averages that I use, that combination that I showed, which is part of what I call my market trend model, those are ones that I've sort of refined and identified over time. These are the moving averages that help me understand the trends that I'm personally trying to trade. The moving averages combinations for you may be totally different, and I think that's important. What I'm definitely not telling you is my morning coffee routine should be identical to yours. We're
mm,
probably trying to do different things in our portfolios, and if so, you want to optimize yours for your own. So a thing like moving average periods, you have the ability to customize those, right? And the general things to think about, the shorter the period, the more sensitive, right? Or the more volatile, right? So if I have an 8 day versus a 21 day, the 21 day is always going to be smoother because it's bringing in more data. So a
yeah.
classic technique, and this is what drives my market trend model, is just looking at shifts when the short term crosses above the longer term or when the short term crosses down through the longer term. Depending
Mm,
on what stocks you look at or what indexes or what futures you might trade, the right moving average combination can make all the difference. I would encourage you to experiment with different settings, with different types of moving averages to find the ones that help. And what I've always encouraged people to do is ignore the moving averages, think about the prices themselves, and think about where you would, where's sort of your ideal entry point and ideal exit point, right? On a chart. What's sort of
mm,
like your perfect, this is about where I'd want to get in, right? I mean, and for me, it's not the actual low. I'm not someone who likes to buy in on severe weakness, I'd probably wait for the market to recover a little bit. So finding moving average combinations that help me sort of generally identify that point, that's how you're going to kind of back into the right answer. Or you could do more rigorous back testing for sure. But I would say focus on that. So this combination actually could be very, very good. And as a
Hmm.
sort of a short-term swing trading time frame, super helpful. I think that would be an interesting one to pursue.
That kind of leads us into the next question. For
Yeah.
day trading or swing trading, what would you suggest as the best time frames to use?
So, yeah, no, really, really good question. My general rule of thumb is think about your investment horizon, right? So, if my investment horizon is like 1 to 3 months, you want to do like 6 or 7 times that amount going back. That's the amount of data you want to kind of bring in, so that the time frame you're trying to think about should be like just this little, section at the right, and you're bringing in a lot more data because you want to you're trying to understand the trends going into this particular moment, which means if your time frame is usually like a couple hours, right? Then we want to go back, let's say a couple days, right? Look at an hourly chart, look at a 5 minute chart, and look at multiple days over time and see what's happening. So and this is the platform that I'm using. I actually jump between different time frames all the time. So daily, weekly, monthly. Up here I have hourly. 5 minute charts because if I'm trading during the day, I'm immediately looking at a shorter term time frame. The good thing about technical analysis tools, some of the ones we've talked about, like moving averages, we didn't talk a lot about price momentum, but something like RSI, it really is scalable. It's called they call it the fractal nature of technical analysis. Shorter timeframes and longer timeframes, the approach should be relatively similar. You may need to change the settings and the periods a little bit. So again, think about what your average trade is, the duration, how long it is, how far off you tend to hold things. Go about 6 or 7 times back for a chart, and that's where I would start, and then kind of customize it from there.
Okay, thank you.
Yeah.
George's asking, we touched on Bitcoin. Do you have any comments or what are you seeing from the charts? And then tying that into MSTR.
Yeah, right. MSTR and one of the many companies who are now Bitcoin holding companies, as
Hmm.
far as I know. For sure. So full disclosure, I do own Bitcoin and I own some Bitcoin ETFs as well. Um,
Same, same.
Okay, so the chart of Bitcoin, I mean, at this point, I would say a very strong price structure, right? What's happened with Bitcoin, and forget about the macro perspective, which I can speak to briefly, but from a purely technical perspective, what makes this chart a constructive chart? I always start with it's above two upward sloping moving averages. I'm using the 50-day and 200-day simple moving averages. That's kind of my go-to starting point. We're above both of them. Just in the last week or two, we pulled back from making a new all-time high around 112,000 down to 100,000 where we literally tagged the 50-day moving average and then pushed back higher. And so that sort of pattern where we're pulling back, testing moving average support, and then rotating higher is kind of a classic bullish configuration. So I think as long as that maintains that general pattern, I'd be very happy with it. I would say just in the last couple days, it's interesting that we made a new high here on very strong momentum. This is the RSI almost to 80, third week in May. Here, this week, as we've pushed just above 110,000, it's a lot lower. So certainly, I'd want to see it rotate higher and see the momentum continue to improve. But for now, I think it's a strong chart getting stronger. And I would say from the quick macro take on this, there's just been such a growing appetite for cryptocurrencies and digital assets. And certainly in the US, the ETFs that have been released, the proliferation of those ETFs, they've gathered a ton of assets. The fact that you now have a presidential administration very openly supportive of cryptocurrencies, I think there's a lot more upside to be had.
Okay, awesome. Um, any charts, specific charts targeting bonds, fixed income
Yeah.
investors? Hmm.
Yeah, these are meat. These are each one of these is an hour-long webcast. I think,
Yeah.
to be
If we
honest,
just
these are meat. I'll give the quick version. This is the 30 to 45 second version.
yes.
For sure, right? And I think if there is a chart besides the ones that we've looked at, looking at the S&P, I think that's the most important way of understanding certainly the U.S. equity market. Start with the S&P 500 and dig into that. Probably second to that would be interest rates. Just this week, right, we have inflation data in the US. Open question mark as to when the Fed would have when they may lower rates, if they lower rates in 2025. Markets pricing in, I think, the first rate cut at the September meeting, which is still a number of months away. which means between now and then the markets are kind of rotating on their own. We also have treasury auctions, which are arguably the most benign, non-controversial things that happen. Now all of a sudden they're a big deal because the question is there an appetite for U.S. debt? And that's kind of sort of being brought into question with all the trade wars and debates.
Mhm.
Having said that, I mean, generally speaking, at this point, rates going up are probably a good sign, I would say, because, when you're looking at like the 10-year yield or the long bond yield, that's basically expectations about future economic growth. And investors are optimistic. They probably sell bonds. Rates kind of go higher, particularly the longer end of the curve, and that represents optimism. So I think the best thing that could happen here after we've pulled back a bit is that bonds sell off and rates start to rotate higher. That's what I'd be looking for going into the summer months. If, however, if rates continue to go down, that would be a dangerous sign because what that means is investors are buying bonds. That would mean they're kind of getting away from equities and risk assets. They're trying to go to more conservative positioning. So I think the chart of the 10-year yield is pretty meaningful. From a technical perspective, we're kind of right at a pretty important support level around 4.3, 435. If you draw a trend line off of the major lows off of the April low, while the S&P is sort of pushing higher, rates have actually broken down through that trend line. So I think it's still
Mm.
an open question, but I think the way that the 10-year yield resolves from here could be maybe the most important thing to really understand the sentiment for the U.S. markets.
Okay, thank you. Maybe one last question we have, a
Yeah,
quick one, about gold.
yeah.
Um, is it overbought? Viewers saying, it just goes up on good news and bad news. Just
Yeah.
your thoughts.
It's the best kind of chart. It goes up no matter what happens, right? If only it could be that easy. So what's interesting, I will tell you, first off, the chart of gold has been remarkably strong for a while. And as I mentioned, I own GLD and IAU, which are two gold ETFs. And own physical gold. The chart of gold has been remarkably strong for the long term. And this is the last 2 years that we're looking at. Remarkably strong chart. If we zoom in a little bit, what we'll find is that we've been consolidating a little bit here. I will tell you, too often investors think of gold as a safe haven, something that only does well when risk assets like equities struggle, that investors rotate to gold. Investors buy gold when they're nervous about inflation. I think all of that is true. But I think what we've found in the last 6 to 12 months is gold is actually can do very well in equity bull markets as well, right? In 2024, gold is a pretty good chart. And in 2025, it's hard to find much better charts, certainly in the first quarter, than gold and gold-related items. What's happened now is we've consolidated a little bit. Gold was overbought going into this peak in April. We had a big candle pattern called a bearish engulfing pattern right in mid-April. That was the warning sign for us. The equity markets had bottomed out in April 7th, had started to rally. Gold all of a sudden flashes this big bearish engulfing pattern, told us we're probably in a pause. And I think that pause has continued. If you look at where we're at right now and where we were about 2 months ago, straight line across, right? We're at that same level. The momentum is actually quite neutral. The RSI is right around 50, and it's been that way for the last 6 weeks. So gold is in a consolidation period. It's basically in a sideways period. So at this point, I think you look to see which way it breaks. I think if gold can get above $3,400 an ounce, take out the most recent high, I think that's a pretty good bullish breakout, telling us that primary trend is going to continue. If we start breaking the 50-day moving average, which is not too far away, that's just around 32.70 on the gold future. Then I would start to be a little more concerned, maybe start to take some off the table. I thought about unwinding some of that position as we tested the 50-day, but it held. And when that happens, that tells me to remain optimistic until proven otherwise.
Perfect. Thanks so much, Dave. We've run out of time. Really appreciate it. And I hope our viewers and our clients appreciate it as well. Thank you so much.
No, it's a pleasure, Michael. Good to see you again. And thanks, Shad, and the team there for being great partners. I appreciate it.
Awesome. Thank you. Have a good evening, everyone. Take care.